Good afternoon, everybody. Welcome and happy Valentine's Day to everybody if you celebrate that day with your loved one. Today is a great day for us because we have our champion in financial modeling, Ellie Eisenberg, here to conduct our workshop. So I'm not going to get into his background because you can read about it or he can tell you about it. But please be assured that we have the best of the best here when it comes to startups needing advice on how to get started from modeling their business model and getting ready for a fundraise. So without further ado, welcome to the Preccelerator U workshop on financial modeling for startups with Ellie Eisenberg. Ellie, take it away.
Okay, so everybody that I talk to these days thinks that they're going to raise venture capital, and VC seems to be still the premier way to go. And I'd like to, before I get into the financial modeling aspect of it, I'd like you to really seriously consider other forms of capital raising. What VCs want, and I pulled this right out of a book that was recently published by Victoria Solchenko, who and you can see her book on the lower part of the screen. There's my window. It's called Raise and Rise. She's a former member of the board of directors of Lava and a longtime colleague of Len. What VCs really want is to maximize the value of their portfolio companies. And that's really all they care about. That means that they might drive you to do something that's not really good for you in the long run, because what they want to do is they want to maximize the value in the short term so they can have an exit and use that experience to raise more money. So they obviously want to maximize their equity stake in their portfolio companies and to have a track record of successful exits. And that may or may not necessarily be the best thing for you. Your job as an entrepreneur, when you're presenting your company, when you're presenting your financials, is to appeal to investors' greed and to minimize their fear. And by the way, if this doesn't get too out of control, I encourage you to jump in with questions. I mean, my preference would be to teach this in real life and to teach it as if we're in real life. So if you raise your hand or if you want to just jump in, if we need to get it under control, we'll let you know. But I'd like this to be as interactive as we can possibly make it. So I'm going to ask you a question. What do you think investors fear the most?
Losing their money.
No, that's not what they fear the most. They know that they're going to lose some money.
Not making enough money to meet their promised returns.
Yeah, that's not what they fear the most.
Embarrassment.
Missing out on a great opportunity.
No, actually, if you're an entrepreneur, what they fear the most is you. Because investors are going to write you a check, and their biggest fear is that you're not going to take that money of theirs and make it into something of value. People do business with people that they trust. They need to feel that you can be trusted to do the right thing, to be honest, to be transparent, to make good decisions, to execute. And so that's, and I don't know, Len, you've heard this ad nauseum as much as I have. Investors invest in people first. That's what they invest in. So your job is, I was saying people, you conduct business with people like and trust. Your job is to demonstrate that you understand business, that you know your specific business model, that you know how to make money, that you know how to execute. This is the key. You may have the greatest idea, the biggest market, fantastic IP. At the end of the day, while that all that matters, it doesn't matter nearly as much as your ability to execute as an entrepreneur. And that's what you have to convince a sophisticated investor that you can do, and that you can be trusted with their money. Goals of your investor pitch, of which your financial model is an integral part, is to build that confidence, to demonstrate credibility, to create trust, as I said already, and to show that you know how you can make money. So why do you need a financial model? Anybody?
The shy crew.
Yeah.
Create a financial
Anybody?
model so they can, you want to create a financial model so they can understand that you know that you have a product that is, or IP or whatever it is, that's worth something, and how you're going to do it. What's your plan, right? And then obviously your plan is going to change, but you know you have a general a solid understanding of what that is, and also how that's going to pivot throughout your journey, and so on and so forth. But that's how they gain trust with you, is if you know your finances and you know how your product is going to be distributed, then they know, you know, that you're someone that they can bet on.
Right. That's an excellent answer, David. Ultimately, you need a financial model to be able to prove that you understand financing, you understand your model, that you understand how you're going to make money. You can convey that to the investor. Richard Morgenstern actually gave me this quote. You know, business plans are seldom required or seen, but I do expect to see a financial model. The reason is that while the actual rarely meets the forecast, the assumptions that underlie the forecast model tells me a lot as to whether the team understands the market and its business, which is what David just said. So let's be honest, no matter what, any financial forecast will be wrong. You don't, I don't know, raise your hand if you own a crystal ball that actually works. Anybody? Do you have a crystal ball that actually works? And by the way, if you're sending me chat messages, I won't see them until after this is over. So if there's something that you want to ask me or tell me, you need to chime in. Investors will come up with their own numbers. And financial forecasting is an oxymoron. You cannot accurately forecast revenues. Now, you know, if your company is Kroger or ExxonMobil or AT&T, you can forecast revenues based on recent history and economic conditions. But if you're a startup with no significant operating history, you can't forecast revenues, but you can forecast what you plan to do. And that speaks to the whole idea of execute. Your plan has to tell a story. It has to be based on what you plan to do, and that has to be the starting point. Any questions here? Okay, we'll continue. You make reasonable assumptions about the results of those plans. So that's what you do. You say, this is what we plan to do. If we do A, we expect to get a certain number of customers. Your assumptions should be based on, you know, the number of leads, number of, you know, clicks, number of, if you spend $1,000 on social media, how many eyeballs is that going to get? How many click-throughs is that going to get? What of those click-throughs, what is the percentage of conversion? And so you build your, and we'll talk about this throughout this presentation, you build your revenues based on your plans and the results of those plans. And you have to build time lags into them as well.
Quick question.
Yes.
What if you come up with something that actually doesn't exist and you don't really have peers in the marketplace that are being tracked, at least not that you know of, and your assumptions, well, there are none because this is a new product, a new technology, and a new approach. How then should the assumptions be approached?
Okay, well, no, that is truly an excellent question. And by the way, it's not unusual. You basically have to, I'm going to use the word guess, but I don't think that the word guess is the right word. You have to say, okay, I have a new product, a new app, a new service, and here's the population of people who could use, or businesses that could use that product or service. You can look at similar businesses and do some research. When I say similar businesses, it could be businesses that have a similar product or a similar channel to the customer. And I should say similar, maybe analogous is the better word to use. And get a sense, what was their experience? And you could even say to an investor, look, I couldn't find anything that is exactly or even close to what we're doing, but the go-to-market strategy for these businesses over here, I think, is really analogous to what we're doing. And this is how they built their company. And so that's the advice I would give you.
In other words, if you forgive me for interrupting.
No, it's okay.
In other words, you look at the closest possible technology, let's say, and well, let's just say analogous technology,
Okay.
and then extrapolate.
That's what I would do.
Okay.
I don't know, Len, do you have any thoughts on that?
I think you explained it right. You have to look at what your serviceable market is and figure out how your business model is going to make money from that market, and then make some basic predictions based on your go-to-market strategy. So I always look at what is it going to cost, the cost of acquisition, and what does that really mean when you're going after that prospect or new client or new customer, and then make projections from there. And I would start very small, make my projections based on maybe the first 100, and then extrapolate to the first 1,000, and not worry about what that TAM SAM looks like, because most people overpredict that to begin with, because they want the numbers to look good.
Well, they overpredict the TAM SAM sum, and they overpredict the percentage of those numbers that they're going to garner. Lamont, investors appreciate entrepreneurs who put thought into their plan, and who take the time to research and to come up with a reasonable explanation as to how you're going to get from here to there. And so if you could, and look, there are very few businesses that don't have some, analogous companies. I mean, I can't think, I can't accept that a business is so unique in the way it's going to go to market, and the way it's going to sell its product, that there's nothing out there that you can't use as a comparative. And so, and I'm willing to be proven wrong, but and if you'd like, we could have a little discussion about this offline afterwards. And there are plenty of mentors here at the Preccelerator who would be glad to spend a half an hour brainstorming with you as to how you go about that. But the answers are out there, and so that's my reassurance to you. It's an excellent question.
Thank you.
Believe me, you're not alone in what asking it. So the purpose of your financial model is, and I know that a lot of this is repetitive, but it's a great way to learn, actually, is repetition. To understand, to demonstrate that you're understanding a business, to test your assumptions. And by the way, there's an old saying that your financial model is obsolete as soon as you publish it. And because you're doing business in a dynamic world things change. Your business decisions will change your direction. You know, you've all heard the expression pivot. Competition will pop up that you weren't anticipating. There are governmental factors such as inflation, the economic factors such as inflation, interest rates. So, what I like to tell people is that, once you have a financial model, you should revisit it probably, at least monthly, and just make sure that the assumptions that you used a month ago are still applicable today. To show how you plan to execute, as we discussed. To estimate how much cash you need. Here's something we haven't discussed. A financial model, if you've done it correctly, will show your revenues, your cash inflow assumptions. It will capture all of your expenses and the timing of those, and determine for you when you're going to run out of money, and tell you how much money you're going to need to extend that, what we call runway, which is your cash lifeline. How much you're going to need to go out 3 months, 6 months, 12 months, and so it's an important exercise for you to go through. Determine how much you can afford to spend. If the amount of cash, if that cash runway is too short, then this model will give you the ability to make some important decisions. I have a client that I had a client. He actually exited at the end of 2021, but he was, his company was a client of mine since 2000, and initially I did a financial model for him for the purpose of raising capital. But what we came to realize was that was a valuable tool in running his business. So every year we would update that financial model. We would go out 2 years. We would look at the staffing in the model, and we would go through an exercise where, I'd say, look, do you really need this person in January? Because if you push that person out to April, this is how much money you're going to save and how much longer you're going to. What about this one person? And mostly we focused on staffing, but we also on other discretionary expenses like advertising and trade shows and things that that are not, when I say discretionary, things like rent are not discretionary in the short run. But the financial model can and should become a tool for you to run running your business, and that's something you should seriously consider. And ultimately, your financial model is to share your financial vision. And this is really important, because even though you don't have a crystal ball, if you do, let me know. I'll take out my checkbook and invest in your company. But investors also want to have a sense of what you think your business is going to do. Whether or not it's going to get there, only time will tell. But I've seen investor pitches I've seen lots of investor pitches, but and I'm sure some of you have seen the same thing, where somebody shows a financial model that shows that they're going to get $3 million in revenues in year 5. Well, and that they're going to be profitable after a year. Well, that's great. It's great for you, the entrepreneur. But if that's your vision, and it's funny, it's not unusual to see somebody with a huge market slide, and then a $3 million, $4 million, $5 million revenue projection out 3 to 5 years. It's like, okay, so you're not planning to go after a large portion of that market. Why would I invest in you? Go find a way to invest in to finance your company and grow it into a lifestyle business. And the other side, the flip side of the coin, is true as well. If your financial vision is such that it's so outrageous that you'd have to be literally crazy to think you're going to get there in the period of time that's shown on your financial model, well, you're going to scare away a lot of investors. So you need to have your model display what you think you can get to reasonably, and that'll also support your credibility. And there we go. And support, but not necessarily make the case for valuation, because valuation is not just a function of your revenue growth and profits, but it's a function of a lot of outside factors as well. And as I said earlier, investors, you may say that your company is worth X, and they may, you may have a really good support for that or a really good argument for that. But investors want to maximize their return as well. So while your job is to support a higher valuation, their job is to support a lower valuation, so that they can get more for less. Your model has to tell a story. It's not just about the business, it's about you. I know I've said this already, but the model says a lot about how you look at your business, how you think about your business. It's not about the formulas, it's about your actions. It's not about the results, it's about how you affect those results. It's the causes that go into it. And it's about the story of your business. What do you plan to do? Okay. Before you can determine revenues and costs, you must identify the activities and timing considerations that drive revenues. And by timing considerations, I'm talking about sales cycle. Some businesses have a very, short click through, boom, sales cycle. Others, I met an entrepreneur about a year ago who was saying that he had this great business, but the problem was that his sales cycle was at 18 months. And his biggest challenge was how to get that sales cycle down. And that's like from first contact to customer to getting a check was an 18-month period. You need to understand in your business what that sales cycle is and what is the time from the time you start your marketing and sales activities to the time you actually get a check. And that has to be built into your model. Identify the partnerships required to provide value. Know what your resources are that you need to have, and derive reasonable cause and effect assumptions to get to revenues. And we'll talk about that a little bit more as well. You need to know who's going to buy your product or service. How much are they going to buy? How much are they going to pay for it? How are you going to use your MVP to learn from the market what you need to do to make it more valuable and more acceptable so that people will pay you for it? Any questions or comments?
There's one question here, Ellie, that came through on chat. Are public company financial models and metrics that can be estimated for their CAC and LTV, cost of sales, et cetera, are they good for entrepreneurs to study and to build startup go-to-market financial models? So basically modeling your financial models after a public company.
That's a really good question. I'm going to say that the answer isn't yes or no. Keep in mind that, when you say a public company, that
It means a lot of things.
Yeah, it means a lot of things. There are large public companies, there are middle market public companies, there are small public companies, there are SPACs, public companies that are probably, don't act like or should even be public companies. I think it's more important. Now, the thing about public companies.
Hello. Yeah. Yeah.
The thing about public.
Barbara.
Someone needs to
Babko.
mute themselves. I got it.
The thing about public companies is that their information is more readily available. So what's really more important is if you can find public companies that are analogous to your company, there are things that you can learn. But a company that's been in business for a long time that has as you scale, your customer acquisition cost should be going down, because every business has fixed costs and variable costs. Costs that are fixed whether you know, over a certain period of time, whether you have one customer or whether you have 1,000 customers or whether you have 1,000,000 customers. And there are costs that are variable, and even variable costs can go down with volume. So, you know, most likely, you know, unless you've identified a way to go to market that is special and that large public companies are not taking advantage of for whatever reason, most likely when you look at public company or big company metrics, you're going to find that their cost of acquisition, customer acquisition, is going to be much lower than what you can do. I mean, let's just, you know, take an example, okay? You know, you hire a vice president of marketing, sales and marketing, and that individual is making $250,000 a year. If you have 1,000 customers, and forget about other marketing costs and just that one, that if you have 1,000 customers, then the customer acquisition cost associated with that VP sales and marketing is $250 per customer. If he or she is able to grow that business from 1,000 to 10,000 new customers a month or a year, let's say, then that customer acquisition cost drops from $250 to $25, right? So, you know, the answer is yes, you should look at those numbers and learn what you can from them, but make sure that you understand how volume affects them and how it's going to be in your business as well. And we're going to talk about customer acquisition costs a little bit in a bit. Okay. Know your business model. How do you plan to grow your company? It's important that you understand what are your customer segments, your unique value propositions, what are your marketing verticals and channels, your customer relationships, revenue streams, key resources, key activities, key partnerships, and cost structure. And then all of this goes into your financial model. You have to do the work. Projecting revenues takes work, and you have to segment. What I see a lot, and I'll tell you, I want to shoot myself when I do, is somebody will have one line for revenues, and they'll have a starting point, and then they'll just use a fixed monthly growth rate. You know, we're going to grow 5% per month. Boom, 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 boom. And the first reaction I have, and the first reaction investors have, is you didn't put any thought into this. That's just an arbitrary growth rate. And the other thing about arbitrary growth rates, if they're fixed over time, any of you who understand the concept of exponential growth, you know that those annual growth rates, so, you know, out in years 3, 4, and 5 can start to get crazy. So what you really need to do, God, I had this meeting with a client last week, and they're redoing it. You need to project your revenues based on the different segments. If you have different sales channels and partners, if you're going in part direct to consumer and part through distribution, you need to project those differently because the margins are different. The costs of going to market are different. This is how you show your investor that you've thought through how you're going to actually grow your business. Nobody waves Harry Potter's wand and makes 5% per month growth. It's just not realistic. It doesn't speak to execution. But if you lay out your sales channels, lay out your customer segments by size, by demographics, by geography, different products or service, different go-to-market strategies. And yes, it complicates the model, but it simplifies the understanding of it. Because now you're saying to the investor, look, we're going to sell this here, this here, this here. We're going to go to market this way. And these are the different results of this segmentation. You've really put some thought into it. And yes, it's work, but nothing worth doing comes easy. Any pushback or thoughts or feedback, questions on this?
How extensive would you recommend in this? You know, I mean, basically, how much detail would you, for a 4 or 5 year plan? This could be fairly complicated.
Yeah, it could be. It could be fairly complicated. And you know, look, if you have two products that are different products but are similar in pricing and margin, you can combine them into a product line, right? I recommend really putting the work in, and you know, if you don't want to do it, you want to just take a shot. You know, I just don't think that shortcuts serve you well as an entrepreneur. And they're not going to, you know, if you do this, if you go through and like, for example, you have, let's talk about a product business. If it were an app or an AI platform or something else, you take a different approach. But let's say you have a product that you're going to sell direct to consumer and direct to retailers. You know you're not going to sell it to the retailers at the same price as you are to consumers, but you also know that going to consumers, direct to consumers, you just, you know, you're going to have a website and maybe some online advertising. But if you're going direct to retailers, you might have to hire salespeople. And so what you do is, I mean, they're really two very different business models. And putting in that work and showing that you understand that all those different aspects of your business will really serve you well. The best thing to do is, I'm sorry, who asked this question?
Hello.
I should put my glasses on so I can see.
It says B2B. I'm not sure who that
Yeah,
is.
see a BSB. Okay, BSB. So the best thing for you to do is to, you know, do a little bit of brainstorming with your team and say, okay, folks, what are we going to sell? Who are we going to sell it to? How are we going to get there? And let's do a projection on each of those groups. You might end up with 2 lines of projections. You might end up with 50 lines of projections. You may end up with, you know, segments and subsegments. But do the work. You will not regret it.
Ellie, if you don't mind, and everyone, I'm a friend of Preccelerator here. I know Ellie, former entrepreneur and GP for Steamwork Ventures. And I will just say every piece of information that is coming across right now is 100% on point. What he is giving you, that advice, you know, putting in the work will absolutely make or break the ability to get the investment, but also to demonstrate the stewardship as you as a leader. So it really will remove the, well, you haven't been a founder before. What startups have you done? If I see a business plan, I'm going to kind of thumb through it. If I see a financial model, I'm going to dig into it. And there are some questions about, you know, being concerned. Yes, you should want to get as close as you can to, you know, the CAC, retention, and things of that nature. But as long as you understand the correlation of activities to dollars in your business, whether it's success or things are not going right, you're putting early KPIs in place and you're creating a baseline for discussion with your investors. And we're coming in as advocates now, rather than trying to sell somebody on the story. Yes, Tam, Sam, Sam, that's all good, but bottom up, like Ellie was saying, is how are you going to get that first customer, that second customer? And knowing what does it take? And when you do, how much money do you need to support that? And if it is a product-based company, whether you have terms, you have inventory, that just cuts so much of the conversation out and really puts you to the front of the line in your conversation with your investors. So you are getting real quality advice right now. And Ellie and Len, thanks for putting this on for everybody.
Thanks,
Thank you.
Tim.
Tim, I owe you lunch. So let's go. Okay. No, thank you. I really appreciate that. Rules for financial modeling. These are fundamental rules. They must be credible. The numbers that are in your model should be credible based on external constraints. If you're, obviously you don't want to forecast or project more than the market will support. Look, you know what? Like I said before, nobody can wave Harry Potter's wand and make a business. It takes time and effort to hire people, to hire the right people, to retain people, to build products, to launch products. And you need to make sure that what you're telling your investors, and really what you're telling yourself, because the easiest person to fool is you. We're all good at fooling ourselves, right? It has to make sense based on what's real in the world. I mean, internal constraints. Growth is difficult, and like I said, it takes time. Now, we don't live in as much of a brick and mortar world as we used to, but if you're in a brick and mortar business, it takes time to find locations and to build them out and to raise the money to do that. The same thing with hiring people and infrastructure and putting systems in place. It has to make sense, and just putting it in a spreadsheet without asking yourself, oh God, I have a client that is actually launching let's call it a chain of a specialized urgent care center. And they're planning to over 5 years to launch 120 urgent care centers in 7 states. And I sat down with them and said, look, how much time does it take? You have to find a location, you have to negotiate a lease, you have to do the build outs, you have to buy the equipment, the furniture, you have to hire the people to run it. So you can't just assume that it's boom. And some things that they didn't even think of. I said, what you're really going to need to have is some people who are like project managers to make sure that these things take place. One project manager isn't going to be able to open 120 centers. You're going to need some regional people, and so you have to look at your business the way it really needs to grow, and not just as a spreadsheet. Or any Excel jockey can put a spreadsheet together, but test your assumptions. Constantly test your assumptions. And the other thing is that there has to be credible through the eyes of an investor. If you put together a financial projection, financial model that no one's going to believe, then you shot yourself in the foot. Even if you believe it, if no one else is going to believe it, if it's, this was a long time ago. I mean, a long time ago, somebody showed us at the Central Coast Venture Association pitch a financial model that showed that they were going to go from 0 to $1 billion in 3 years. And I raised my hand and said, that's just not realistic. He said, well, the market is 20 billion. I said, yeah, just because the market's 20 billion doesn't mean that you can grow a business in 3 years to 20 billion. He said, well, to 1 billion. He said, well, and he named another company. I don't remember if it was Apple or Compaq or whatever. He said, well, Apple did it. I said, so you're telling me you're Apple? I said, not, you just have to keep in mind always, how are you going to be perceived when you present your numbers? Because even if you believe it, if they're going to think you're crazy, there's no deal to be had. So put your shoes in yourself in the shoes of the investor and look at it from the outside looking in. And by the way, this is where I really recommend before you go out to investors, that you have some friendly advisors, some people who maybe are even in the investment community, who you're not going out to, you're not pitching, you're going to them and saying, would you take a look at my financials? Would you take a look at my deck and tell me where I need to fix it so that it will be, it'll make sense to potential investors? Don't ever assume that you know more than the people who are out there. Okay. The next thing is it has to be supportable based on detail, based on outside benchmarks. If, for example, you're going to rent space in Santa Monica and your financial plan says you're going to pay $1, per square foot, and everybody else is paying $5 or $6 per square foot, then you haven't done your homework. It doesn't make sense. Same thing with salaries. The same thing with pricing. And your pricing has to make sense compared to other analogous companies or competitors. So looking at outside benchmarks is really key. Putting the model together. Len, how much time do we have? We're going
to go until 1:15.
1:15. Okay. So, we're getting close to the end of the PowerPoint portion, and maybe I'll get a chance to bring a financial model up here. I do want to say this. If any of you want to do a little deeper dive later on, I'm happy to, to have a follow-on session where we just play with some financial models, and I can show you what I have, how I go about doing it. Follow convention. This is not meant to be an exercise in creativity. It's meant to be an exercise in showing that you have a level of knowledge and sophistication about business. There are a lot of templates out there. There are a lot of people who are creating, standard models, and maybe I haven't seen one yet that I like. And if any of you are involved in one and you have one that you like, I'd be happy to take a look at it. But if you're going to tell your own story, I really believe you should develop your own model. It should be tailored to your business. It should do the things we talked about earlier about segmentation. It should be detailed about who you're going to hire and when you're going to hire them, what you're going to spend money on and when you're going to spend money on it, advertising, trade shows, other, PR, other kinds of promotion, equipment, insurance, just all the detail. It should be a bottom-up detailed approach. The one thing that I really want to caution you against is using percentage of revenues assumptions and coming up with your expenses. Yeah, it's easy to say, well, we're going to spend 20% of our revenues on sales and marketing and just plug in 20%. We're going to spend 15% on R&D and just plug in 15%. That's not how that's not how you grow a business. I want to know what you're spending it on. I want to know who you're hiring and when, and what's the thought that goes into it. If I'm an investor, well, I am, but that's not the point. Do not use a lot of worksheets. This is something that will drive. Keep in mind what's going to happen is there are going to be 2 or maybe 3 phases of interaction with an investor. There's going to be the initial introduction, the pitch. Then they're going to have you, if they like it, they're going to have you have a more detailed one-on-one presentation where your pitch will, instead of a 5 to 10 minute pitch, it's going to be a half an hour pitch with Q&A, and you're going to really have to do a deeper dive. If they like that, you're going to get into due diligence. And what's going to happen in due diligence? Send me the model. They're going to want to see the model, and they're going to hand it off to one of their, junior associates, going to do a deep dive. And so your model has to stand on its own 2 feet. And the way to do that is with a bottom-up detailed approach, not a top-down broad ratio approach. Do not use a lot of worksheets. If you create a model that is difficult to navigate, the investor will get frustrated during due diligence and they'll move on to the next. My models have 1 tab for revenues and cost of revenues, 1 tab for your expenses, 1 tab for your monthly financials, income statement, cash forecast, balance sheet. And the reason why I advocate this, and any of you who worked with Excel models or Google Sheets models that have 20 or 25 or 30 tabs, know that off here to the right are a bunch of hidden tabs. And those hidden tabs, it creates complexity and difficulty in reviewing the model. You want to be able to see all the tabs in front of you. The more tabs you have, the more links between tabs you have, the more potential for error you have in your formulas. So what I like to do is, and it's a lot easier to navigate vertically in checking formulas than it is to go from tab to tab to tab. It's just much easier to navigate. The drivers, the assumptions, and then people say, put all your assumptions in assumptions in one place. I don't like that approach. I want to see the assumptions here and the numbers that they impact on the same line. So that if you change it, you can see the change right away. We have 20 minutes. I'm going to get there. So I'll show you some examples of what I'm talking about.
Just before you, excuse me, if I can interrupt, just before you switch gears there. If we circle back to your example, I think you were talking about the planned specialized urgent care units.
Yeah, okay.
Those guys don't have a product that they can go out and advertise for. I mean, at least I don't see very many advertisements for urgent care centers and that sort of thing. And they're in a business that could be affected by whether or not the market is driven by value-based care or fee-for-service.
Mhm.
So you got two different directions that would, at least two different directions, that their revenues could be generated from. So in the presentation, should those both be addressed as possible, let's say,
Yeah.
paths for the business to develop over time? And this is what would happen with value-based care. And that's what's likely to happen if we continue with fee-for-service.
I think that's correct. What I would do in a case like that, we did something a little differently with this one because what I did is actually I created a template for each unit, for each urgent care unit, and we create when I say we created our own template. I did, and 3 different sizes of urgent cares, and then we projected out the launching of each one, referring back to the template. But what you can do in a case like that is you can have one line for fee for care and the other for I don't remember the terminology you used,
Value-based care.
that and then you can have percentages. So 80% is going to come from this and 20% from this, or maybe it'll be 60-40. Let's take a look. And if you build your model correctly, all you have to do is change that 60 to an 80 and it'll automatically flow through the model. So if you want, we can talk about that also later. So be granular. I like to tell people that the input fields you should. A lot of this has to do with developing habits that subconsciously as well as consciously reduce the chance of making errors when you're putting together a spreadsheet. So what I do is any field where it's okay to input information, I make that some color other than white. And any field that has a formula where I don't want my clients to screw up the formula, I just leave it blank. I leave it white. So I say, look, you can do whatever you want in the fields that have colors, but the white fields, don't touch them. Believe it or not, it helps me when I'm creating the model because I've trained myself to work that way. Don't ignore cash flow implications. Revenues don't necessarily equal cash. If you're in a business where, it's click through, pay for it, and that's it. That's great. If you're in a business where you have to invoice customers and they're going to pay you in 30 days or 40 days or 45 days, in case of the urgent care, it's 60 to 90 days because they have to submit, to insurance and to governmental agencies. You need to build those cash flow formulas into your there's an old saying in the accounting world. Krista will appreciate this. It's easy to go broke while you're making money, right? You can be profitable and cash flow negative, and especially if you're, if you have to pay your payables faster than you can collect your receivables, and especially, they say there are two reasons why you run out of cash. One's a good reason, one's a bad reason. The good reason is you're growing so fast that your cash collections can't keep up with your growth. And that becomes really important in a business where you have to buy inventory. And there are ways to finance that as well. The other reason is it's because you're losing money, because your expenses are greater than your revenues. So don't ignore the cash flow implications. It's really critical. Horizon, we say traditionally should be 3 to 5 years or until exit. Investors like to see 5-year plans. I'm not sure that there's any real good reason behind that other than it's customary. But if there are businesses, for example, if you're developing a pharmaceutical where you might not see revenue for 10 or 15 years by the time you get all through all the clinical trials. So what do you do? What do you do then? That's a whole other thing, and I'm not going to dive into it. But if you're developing a pharmaceutical, what you really need to show is the efficacy and or presumed efficacy, and how long and how much money it's going to take you to get through your clinical trials, because a lot of times those businesses are sold pre-revenue to large pharmaceutical companies who see your startup as an extension of their R&D. Next one, I really want you to pay attention to this. Forecast by month. There are people who are going to tell you just do the first 12 months and then do annually or quarterly after that, or do the first 12 months and then 4 quarters and then annual. The model breaks down when the column, the 12th column is monthly and the 13th column is quarterly. It just breaks down. There's no way to make that transition a smooth one that makes sense. That's number one. Number two is you really want to see where the cash trough is. And if you start forecasting by quarter or by year and you're not seeing what's happening in between, you might miss that and underestimate the amount of cash that you need. And you should review and test. There should be checkpoints in the model.
I have a quick comment about hiring, and this is Anthony. Sure. And one thing I notice when I see people's financials is they'll say, hey, I'm going to hire 10 people, and they've allocated no cost to how much it costs to hire someone, how much it's going to have to employ them with benefits, employee taxes. It's all like, oh, I'm paying one person $100,000, so I have $100,000 in my line item. But it's like, that's going to take you 6 months. You're going to spend $15,000 on LinkedIn ads. You're going to have to pay all these other things. So can you comment on some things that show that this is an unsophisticated founder versus someone's like, oh, wow, this person's done it before. Look at how detailed their costing is. They clearly have been burned in the past, and they've been very detailed in this model.
Okay, I'm going to do something here. And we'll jump back to the PowerPoint in a minute.
Sorry for the distraction.
No, it's okay. What I do in my models, and what I strongly recommend, is that you have a detailed, can you see this, or I can make it?
Yeah, we can see it.
Detailed staffing plan, employee start date, salary, and for example, if the start date is 7/1/23, you'll see that what happens is in the white fields, the ones I said that you don't want to change, that just got moved out to July, right? If I change this one to 8-1, it just moves out to August. The other thing I have in this section, because it's all related to staffing, payroll taxes, workers' comp, recruiting and relocation, medical benefits. Now, medical benefits are a function of headcount, not salaries. Anybody who wants to forecast medical benefits as a percentage of salaries is not doing it the way it actually is in business. So I do this for G&A, for sales and marketing, for R&D, identify the people we're going to hire, when we're going to hire them, how much we're going to pay them. Obviously, you can see this is a model that was originally built a long time ago, and all the ancillary costs that you're talking about. So when you do that, Anthony, right?
Yes, sir.
Again, you're showing your investor that you understand business and what it costs to run a business, and that you've taken all that into account. I do the same thing with office space. I drive that off of headcount, although this is a pre-COVID model.
Pre-COVID model.
So, okay.
Is that what BC stands for, before COVID?
It could. What did I do here? All right, current slide. All right, that's just the way. I don't remember how
You went to display settings and you swap. You go to duplicate slideshow. Go down. There you go.
There we go. And I'll get rid of this. Okay, that's fine. So the best way to show revenues is a cascading approach. Your sales, and it starts with your sales and marketing plan, your costs, your resource, your timing, who you're going to hire, what you're going to spend it on. That's going to generate leads or eyeballs, which is going to lead to paying customers based on conversion rate, which results in a number of transactions or sales in units at a price that translates into revenues. And you have to take into account beyond that, okay. All right, so very quickly, the resources that I'm referring to here: sales team, advertising, promotion, content development, content delivery, customer support, business development, partner development, all these things, to the extent that any of them are relevant to your business, you need to show what those costs are. Then you've got this cascading idea. So, you get down to the pricing model, which is really important. How will you price? How will your pricing be defined and quantified for each revenue source? Is it a price per unit for product? Subscription? Is it going to be monthly? It's going to be annual? It's going to be recurring? What about renewals? There's something that we call churn. I think that you should be projecting renewals on a different line than you are new subscriptions, so that people, investors can see, all right, what are the new subscriptions, and some, is it going to be a 90% renewal or 80%?
Yeah, you're going to make that estimate on churn.
Right. So direct costs, if it's a product, labor, material to produce a product, you may have to pay royalties if you're using somebody else's IP, commissions if you're paying salespeople or outside salespeople, again, staffing and related costs, product design, all this goes in. Other costs, I'll just go through this really quickly, just overhead expenses, insurance, legal, rent, utilities, accounting, etc. And then you have your startup or other capital expenditures, such as furniture and equipment, which is BC, before COVID, server equipment, software build, outsourced, if you need to have outsourced IT, these things. Now let's have a word about CAC and LTV. Investors these days want to see that what your cost, your customer acquisition cost and long-term value is. Customer acquisition cost, and here's where I think a lot of entrepreneurs miss the boat. It's you have to take into account all sales and marketing costs, salaries, advertising, trade shows. If you have salespeople and you have to pay for them to have cell phones, that has to be included. I mean, whatever you're paying for in the effort of acquiring customers should be the numerator of that formula. And then you divide that by the number of new customers. And it's going to change. It's going to change month to month, quarter to quarter, year to year. So, having one customer acquisition cost is somewhat misleading. You could say that, look, over the last 6 months, it's been this. We projected it will go down over time. I mean, you just need to be able to look at it. You can average it any way you want, but as long as you're conveying that to the investor. And the long-term value is the total revenue per typical customer or client over a reasonable period of time. It really relates almost exclusively to businesses where you have recurring revenue type of sales. I mean, if you're selling washers and dryers, the long-term value is the sticker price, right? Although there may be a service contract associated with it. But, I think people tend to overcomplicate these. And I don't think that there's really much complexity to it at all. Again, if any of you want to comment, I welcome you to do so now.
No comments.
People always ask me, why do you need a balance sheet? If I can show income, and profitability, revenues and expenses, and cash flow, what difference does a balance sheet make? First of all, it will show the differences between income and cash flow. For example, accounts receivable, accounts payable. And a balance sheet will always reveal errors in your financial model. I mean, I've seen financial models where where receivables just keep growing and growing and growing and growing, to the point where it just doesn't make any sense at all. Same thing with payables, same thing with inventory. And what that means is that the timing differences or the formulas in your model between revenues and cash receipts, between expenses and cash disbursements, there's something amiss in that presumably more critical part of the model. So you really do need to have a balance sheet. When presenting, don't use tables like this. And I just want to say that the reason why I for a pitch deck I'm talking about, this is fine for for when you're handing it over to the investors. But if you're pitching, especially to an audience of a number of different people, number of different investors, you want your presentation to be about you. You want the focus to be on you. You want to make that connection with your audience. When you put up details of numbers like this, you're literally putting up a slide that's competing with you. It's going to steal attention away from you, because human nature is to start to study these numbers. And you don't want them studying the numbers at that point. What you want them to be doing is looking at a slide that tells the story. That basically says, look, you can see there's revenue growth, you can see there's profitability growth. You don't want them studying the numbers. And so that's really all I have to say about that. If we could take some Q&A, I can we're pretty much out of time, but I can bring up a spreadsheet and show you a couple of things that I was talking about earlier. Len, what would you like to do at this point?
So I have a comment here from someone. Could you ask Ellie to give a quick example on how equity changes with each round of investments? E.g. Creator starts with 100% equity, then goes through 2 or 3 rounds of funding. Does that make sense?
It makes sense, but All right, let me talk about that because it's something that's always going to be on your mind. Gene Kleiner, who was one of the godfathers of venture capital and somebody who I was privileged to have as a personal friend and mentor, once answered this question for me, and he said, look, in the perfect world, you always want to be raising enough money to get to the next significant milestone. And by significant milestone, what Gene was saying was a milestone that increases the value of the company so that you're always, diluting the company less with more money down the road, and then allow yourself 6 months to raise that money. So, in the Silicon Valley world of the 1980s, in which I was cut my teeth, which was primarily a hardware world. It was pre-internet, it was pre-mobile phones. We're talking about computers and equipment. We'd say, raise enough money to proof of concept, then raise enough money to have a working prototype, and then raise enough money to have a manufacturing prototype, and then raise enough money to launch. And so that because at each of those major milestones, there was a higher perceived value, and you could raise that round with at a higher value, less dilution. Again, you're dealing with the crystal ball issue. Some people say just raise as much money as you can. That's not necessarily a smart strategy. If you can wrap your head and your team around, what do we need to do to get to the next round at a stepped up value, and give yourself some buffer. But I think that's what you want to do. There's some waterfall models that I've seen, but the problem is that they all assume that you know what the future is going to bring. There's an old saying in the venture world that it's better to own 1% of something than 100% of nothing, right? My best advice to you is that you surround yourself with good advisors, with people who have experience in the financing and money raising world, who you can run your business by, who you can have these conversations with, who can help you decide how much money you should be raising and at what value, and know that it's always a negotiation, right? You may have your idea. Look, we've all seen Shark Tank, right? They come into the Shark Tank, and we're raising, $500,000 for 5% of our company. That doesn't mean they're going to get it, right? And it doesn't mean that you're going to get it. You may not have a business where you can raise the amount of money you need and retain control. You have to be realistic. You may decide that, I'm just going to bootstrap this thing. I'm going to find a way to make sales. And by the way, sales are the cheapest form of capital. If you can run your business as if you're never going to get capital, and make sure that, that one of the biggest mistakes that entrepreneurs make is convincing themselves that they can't do anything without capital, and they spend all your time raising money. Don't spend all your time raising money. Spend most of your time building value. Because if you can do that, and if you could build value without outside investors, then you're proving to them that you can execute, and you're actually making it easier to raise capital.
So Ellie, we're coming down to the end here. I did share your email with the crowd. Several people asked for it. So you're going to get a bunch of emails. Sorry about that. But also another question has come up. How has the time between rounds and average step ups changed over time?
That's also a really interesting question. I can tell you how it's changed over the last 12 months. You know, with private equity, private capital, it is not as independent from public markets as you may think. We are seeing valuations, you know, from 2019 to 2020 to 2021 to 2020, well, 2021, we saw valuations in the public sectors increase tremendously. And then in 2022, we saw the markets, depending on your portfolio mix, people were losing anywhere from 10 to 50% of their portfolio values, and 25 to 30% was not unusual. Valuations have come down. They've come down because the public markets, because of inflation and nervousness about the economy. A deal that would close quickly, at a 10 million market cap a year ago, might not even close quickly at half that value today. The thing I have to caution, I think you, Len, and Tim, and other people on this call would acknowledge this as well, is that no two situations are identical. If you have a great business and a great team and a compelling value proposition, you'll get funded. Maybe not as much as you would have gotten a year ago, but you have a good chance of getting funded. If you don't, then it's a lot harder. There's a lot of what they call dry powder out there, which is cash sitting on the sidelines at VC funds and public pension funds and other and family offices. And a lot of that is being held back to bail out or to extend the life of existing portfolio companies that have been affected by the economy, and which means that there's less available. I shouldn't say less available, less willingness for that money to be invested in new portfolio companies,
or more competitive.
Right. But the money's still there. And if we've learned anything from 1989 and 2008, it's that when these windows close, they don't stay closed, because there's nobody makes money if they don't invest it. And so these funds have pressure to invest, and they can put everything on hold for 6 to 9 months. But eventually, unless the economy tanks in a way that none of us want to talk about, eventually some of that money is going to free up and it's going to become more available for good companies. And the thing is that if I've learned one thing in my 50 years of adult life, I'm that old. it's that things happen in cycles. And that this is not, it's not new. It's new if you're if you're young, if you're in your 20s or 30s, it's new. But this is one of the things that down economies do is they cleanse the economy. People lose jobs, people get hurt, companies go out of business, but the really good companies, the really good people survive, and we come out of these down economies stronger and better off than we did going into them. And that's, I'm not saying it's a good thing, but economic cycles are a necessary evil. And so hang in there. If you have a business and you can't get funding for it, figure out a way to get customers, figure out a way to hang in there, keep your expenses down as low as you can, and keep fighting, because if you can survive this, you're going to look pretty good to an investor down the line.
You know what, I as a closing question, I have to ask this one. Not everyone is going to have the serendipity to get a presentation by Ellie Eisenberg, or to even happen to laterally meet Tim Arnold or Lynn Lonzi and that kind of thing. You said we should surround ourselves with the likes of you guys. So how does somebody who's not a somebody do that without the warm introductions? I know that's inside baseball, pun intended, but that's an art in and of itself, I think. Talk about that.
I can hop in on that. Just like parenting, 90% of it is showing up. And everybody has some kind of background or expertise that they can lend to each other. And if you show up and you are looking for a two-way true relationship, that you'll become a magnet force, because good actors always get supported in there. And they're luckily, especially in the LA ecosystem, there are so many events, more than you can get to, is getting there and really thinking, what can I do for somebody? And then what can I get after that? If you put others first, this is one person's opinion on it. You show up with a good heart, it'll be reciprocated.
Great.
I agree with that wholeheartedly.